Hello everyone and welcome to this week's FX update. My name is Craig Erlam, Senior Market Analyst at OANDA. Thank you all as ever for joining us this week. I hope you had a fantastic long weekend, the length of which obviously depending on where you are. Thankfully here in the UK we had a 4-day weekend, so I myself feel much more refreshed. It doesn't seem like I missed much at the start of the week, to be quite honest. The main story really is in oil, and we will touch on that because it really does relate to the Canadian dollar, for example. But I think it is also a very important geopolitical story as well, so it's worth touching on shortly. Hopefully everyone can see my screen and you can see the OANDA MarketPulse website in front of you. This is where myself and my colleagues around the world post content every day. It's also where you'll be able to find the recording of this webinar, hopefully later on today, as well as on YouTube, and I'll also post it out on the usual channels like Twitter and LinkedIn, etc. So please do check us out there. If you want to follow me on Twitter, my handle is Craig_Forex. And like as you can see, it's also where we post a podcast as well. So that's the video version of the podcast, and this is what we put out every Friday, previewing the week ahead, and it's also where the other podcasts lie as well. It's also where you'll find the economic calendar, which is just here, and on this next tab is where I've already set this up to contain all of the items which I'm going to talk about today, the currency pairs which we're going to cover and what could impact it. As ever, this is meant to be an interactive session, so please do not hesitate to reach out if there's any charts you want me to look at, if there's any questions you have about what I've said, please just ask. I'm always willing to help where I can, and I want you guys to get as much of this from this session as possible. So please do not be shy. As you can see, the economic calendar in front of you, first thing that strikes me is it's quite light. Now, that shouldn't come as a major surprise. It has been a long bank holiday weekend, so the first couple of days of the week are always quiet. It is also just one of those weeks. The third and fourth week of the month do tend to be a lot quieter than the opening weeks, especially when we don't have many central bank meetings that fall on them. Of course, you look at something like the US and the ECB, the US Fed and the ECB. These are every 6-week meetings, so they are a bit more. Where they land is a little bit more random. But when you have weeks like this week where they don't land on this particular week, it can make the week of the bank holiday all the more quiet. Not necessarily a bad thing, if I'm honest, because participation does tend to be a little bit lower. People obviously making the most of the Easter holidays, kids off from school, etc. So that can weigh on activity as well. So when it's not the most active of weeks, it's not the end of the world. As you can probably see from the right-hand side, the last post I made referencing earnings season. This isn't something which you'll find on the economic calendar at this moment in time, highlighting companies that are reporting earnings. But I think that's going to be a major market mover this week. Given that it is a quiet week in general, we're not expecting too much news from the US over the course of the week. In the UK, we're on Easter recess in Parliament, so Brexit news flow is expected to thankfully be very quiet. But we do have a lot of companies reporting earnings in the US and Europe. Some European companies are joining as well. I think there's around 150 S&P 500 companies reporting earnings. Around a dozen of those fall within the Dow Jones as well. So these are some very large companies reporting this week. Large focus on the tech space, for example. So Twitter today, for example, again, this could be very important in terms of sentiment in the markets, directional travel. We've got US indices near record highs now, and I think this earnings season could be quite pivotal at these levels. So aside from the actual data which we've got in a couple of central bank meetings, I think this is something which I would personally keep a very close eye on. And a good place really to get some interesting insight on that is FactSet. They release earnings updates every week, and I think they can be quite handy just to get a grasp, if you're not following it too closely, on how what the general movement around earnings season actually is. But what we have in front of us here is the economic calendar. And as you can see, like I say, very quiet at the start of the week. A couple of pieces of housing data from the US, but not really up to much. We've got the IFO tomorrow, which I think is quite interesting given the amount of emphasis that we're seeing on Germany at the moment. We've got the combination of very weak PMI readings and sentiment figures coming from Germany. The fact that it's just about escaped recession, just failing to post 2 quarters of negative earnings growth. Italy already in recession, of course. A lot of focus and emphasis now on the actual region. The ECB has very much pulled back from its expectations of a rate hike this year, now very much next year at the very earliest. So there's a lot more focus really on these sentiment surveys from the likes of Germany. So this IFO is going to be very interesting as far as I'm concerned on Wednesday, especially again in an otherwise light week. Bank of Canada on Wednesday afternoon, I think again is going to be another closely followed. Simple reason being, well, of course, Canada's a large economy, that goes without saying. And if you are following the loonie, the Canadian dollar, then of course this is very important. But the other reason why I think is very interesting is because of how closely linked the US and the Canadian central banks have been, in that they've both been ahead of the curve in terms of raising interest rates. The Canadian central bank probably to an extent has been more heavily criticized in doing so because it hasn't necessarily done it from a position of economic strength, and there's been plenty of questions raised during that time about whether they should have been raising interest rates. But we're also expecting very much pause here, and markets are very much pricing that in. So it'll be very interesting to see if we do see more of a dovish message from the central bank on Wednesday to accommodate that, as we've seen from the Federal Reserve, which isn't anticipating another rate hike this year and only one next year. We follow this on Thursday morning with the Bank of Japan. Thursday morning, of course, UK time, Wednesday evening in the US. And we're not expecting too much from here. Bank of Japan Governor Haruhiko Kuroda did suggest, I think it was last week, that more stimulus may be needed. Now, how they would actually do that, I guess, is one thing that we'll be interested to hear on Thursday. Simple reason being, the Bank of Japan already owns an enormous amount of Japanese government bonds. So to try and increase that, I think would be very challenging for the bank. And on top of that, it's very questionable just how successful the quantitative easing program has been in Japan, because they're still failing to achieve their inflation goals or even come close to achieving those inflation goals. Now, of course, it is extremely challenging in Japan. This is a country that has long had low levels of inflation, low levels of economic growth. But at the same time, when you're undertaking such unconventional monetary policy measures, you have to be able to justify it. And for the Bank of Japan to decide that more stimulus is needed so that you're going to buy a few more bonds, that strikes me as just chucking good money after bad. So you would question whether they would experiment in other ways in order to provide that additional stimulus. We've seen, for example, in Europe, and again, this is questionable how effective it's been, we've seen them dive more into negative interest rates. I know Bank of Japan has got minus 0.1. In Europe, though, it's minus 0.4. It'd be interesting to see if they could potentially go down that route and whether that could have a positive impact as well. So I think that's what one of the interesting things that could come out of the Thursday morning's meeting will be. We've got durable goods orders and initial jobless claims in the US, and again, this can be quite volatile but also very interesting. I've said before in these webinars, the interesting thing with durable goods orders is the fact that it's a good indicator of current activity but also longer term expectations. By definition, durable goods are goods that last longer, large items, larger purchases that last longer than 3 years. So if you're investing in this, whether it be IT, infrastructure, machinery, whatever it is, it's a vote of confidence in many ways in the outlook. So you would expect these numbers to suffer in the event of an economic slowdown or an expectation of an economic slowdown. We've got more Japanese data coming on Thursday evening, Friday, of course. So if you're over in Asia, the unemployment rate, job to applicants ratio, etc., which again is going to be quite interesting also. And then that wraps us up on Friday. And I think this is the standout really for the data releases because we're coming on the back of a very questionable quarter. So GDP data from the US for that first quarter, I think, is going to be very interesting, very closely watched. Again, we've just come on the back of a year when the fourth quarter numbers were slightly worse than previous releases suggested, and also showed that the US didn't achieve the levels of growth across the course of the year that it was expecting, which, when you're considering the size of the stimulus package from tax cuts provided, that is naturally a bit of a concern. And then we got the University of Michigan Consumer Sentiment Index, which unfortunately I just think comes a little bit late in the week to get the attention it deserves, but that's how it is. Personal consumption expenditure prices as well is one. The price index, the inflation figure, which people may occasionally get confused with. That's released a day later, so that'll be early next week. That's the inflation reading. That's the Fed's preferred measure of inflation. That's released, so that'll be released next week. But I don't think this will be necessarily ignored per se. It's still an important piece of data. So with that, let's move to the charts, and we'll start with euro dollar. And unfortunately, what you're going to see today is similar to what I said last week, really, and that is that we're still very much range bound in many cases, and we are seeing some consolidation, for example, here in the euro dollar pair, but we're not seeing a dramatic change. We are now consolidating, if anything, in a tighter range over the past 3 or 4 days. We saw the sell-off here in the pair last week. That was the 18th, so that is last Thursday, and since then we've just seen consolidation around the kind of mid 112 range. I think that was on the back of some poor German data, if I'm not mistaken, the PMI, the manufacturing PMI data that we had from the Eurozone, France and Germany, and we saw again some more disappointing figures here for the euro as a whole as well. So that was what triggered the sell-off in the euro and provided some near-term support for the US dollar. But we've just seen sideways trading since then, and again, Friday was a bank holiday, Monday was a bank holiday here in the UK, and it's just been a slow start, and it's just been slow trading since then. So that's why we've kind of seen this kind of sideways trading. But it is also a bit of a continuation of what we've seen for some time, in that we are in a consolidation mode at the moment in many FX pairs. It's why people are taking more of an interest, for example, in other instruments. Gold and oil, for example, have been far more interesting in many cases. But again, also linked to the US dollar. But nothing's really changed here. I know this just looks like a lot of blue lines across here, but what this effectively represents is the lower bound of this longer term range. I would love to see a breakthrough 114, as I've said last week. And who knows, let's see how the next couple of weeks pans out. I think with that could potentially revitalize this currency pair. If we do trade back towards the lower end of this range, around the kind of 112s, and maybe even make a new low, I'm not going to get particularly excited just based on what we've seen already previously. I think we really do need to see a break higher in order to achieve that. But momentum is still to the downside, but we're just still seeing consolidation. So there's nothing really new to report on from that perspective. I don't think it helps that both central banks have set out their stalls quite clearly, quite transparently, and also really pushed back expectations. So when you're not expecting any changes in monetary policy for a good 12 months, it doesn't tend to do too much for those currency pairs and for volatility in general. Cable similarly has really frozen, and the pound in general has really struggled since the Brexit delay was announced, because it feels like, on the one hand, we've not been given any direction, and we've been given a 6-month extension, which really doesn't, it just leaves you in wait and see mode. It's the ultimate can kicking in many ways. It doesn't change the outcome per se. In one way, it gives the impression that no deal is again increasingly unlikely, but unfortunately it's still on the table, and therefore it can never be completely written off. What still remains evident, as far as I'm concerned, is that we're still seeing profit taking. I feel like we saw a lot of long positions being built up on the expectation that a deal would happen, and that is still the base case scenario. But whether traders have the patience to wait 6 months for that. The recent price action suggests not. We're seeing a series of lower highs. So for me, the pressure remains on 130 to the downside. That seems to be the path of least resistance. But we are now just seeing consolidation over the last 4 sessions. If we do see a break below 130, below this kind of moving average cluster, then 128 strikes me as the next clear area of support. It's where we saw the most recent low. But if we look back on the chart, this is where we've seen areas of support and resistance before as well. So that strikes me as the next clear potential area of support. But again, whether that's going to be enough to actually be the catalyst to spark a bit of life into it, we'll have to wait and see, because it's clearly lacking at the moment. I think that's safe to say. The same is very much true in euro sterling, which again shouldn't come as a surprise. If it's euro dollar cable saying the same thing, then euro sterling you would expect also. We're back at the top end of the range here between the 86.50s and 87s. We're struggling to break above. Momentum still is with the upside. We're still seeing a series of higher lows. We've kind of got this resistance around the kind of late 86s, 87, which suggests the path of least resistance in this case is to the upside. If we do see a break through 87 and 88, again strikes me as notable potential resistance, given that it's got history, but also we've got the 200, 233 day simple moving average coming in there. So potentially that may be being, it may be something traders are keeping an eye on. But broadly speaking here, nothing has very much changed. We still have the longer term range, 85 to 87. We're still within that range. It's just a case of whether we continue to see profit taking and whether traders who remain short throughout this period are eyeing this as a potential sign that the trend is weakened. We'll see how we hold up around these levels. What's different between euro dollar, cable and euro sterling is that we are seeing this kind of curvature. So this may be a sign that even this recent trend is weakening, and we can look at the momentum indicators, and they very much do suggest that as well. That's not to say that we won't see a breakthrough 87, but it may just mean that we may see a bit of a corrective move prior to that. Again, unfortunately, not incredibly exciting. It's consistent, really. I think there's interest to be found in other pairs, though, and I think this is potentially one of them, to be honest, the Australian dollar versus the US dollar. I think one of the reasons why this is more interesting is because of the close links between China and the Australian economy, and therefore the vulnerability or the sensitivity of the Australian dollar to news and events and data coming out of China. Now, we have seen the Australian dollar trending a little bit lower recently, but upside support really has come from the fact that we've had stronger pieces of Chinese data, whether that be the PMI readings that we had a few weeks back now, the manufacturing, both official and Kaijin indices. We had trade data, the imports and export data. We've also had the GDP data last week, which showed that growth in the first quarter was ever so slightly quicker than we expected. I think it was 6.4% versus expectations 6.3%, suggesting that some of those stimulus measures that have been implemented are working, particularly with regards to things like tax cuts, but there's also, I think, sign of infrastructure spend there as well. These things are having a positive impact, not necessarily long-term solutions, but short-term support at a time when the US has engaged in a trade war with China, and which is clearly having negative impacts on the economy at the moment. However, looking at this chart purely from a charting perspective, we've still got this floor around these kind of 70s, around the 70 levels. I highlighted 70 through 71 because each time we come back, it's in this area that we kind of see support and resistance. So I'm not really interested in one particular level. If we do break through 70, then that could suggest that that's a very a nice bearish signal. And the fact that we've had this series of lower highs along the way while maintaining this floor would suggest that momentum is with the bears still, from a purely technical perspective. Personally, I would like to see a breakthrough 72 more so, because that would take us through that falling trend line, through the moving average cluster, through the previous high, and that could potentially be the trigger to bring some life back into this pair as well. Otherwise, I feel we could see further consolidation. Again, can you see the consistent message which unfortunately we're seeing in the markets right now? It really does feel this really does have kind of an August 2012 feel to it. The kind of and I've just picked that month out of my head, so don't go researching that month. But middle of the summer, back at a time when volatility was extremely low, it does have that kind of feel to it. And until we see a breakout from these consolidations, I mean, I know this sounds obvious, but it just doesn't feel like it's ending. We're lacking major news, which is going to be the driver of this. Like I say, I really hope earnings season could be that driver. And I think this is one of the pairs that has the potential to potentially move more so than the others because of the links to China. Another one that falls in that bracket is dollar CAD. Now, I know you may not gather that from the chart that we're looking at right now, but we are seeing a lot of movement in oil prices at the moment. We're seeing a lot of oil-related news, and the oil and the Canadian dollar are closely tied because it is a major producer, major exporter, and therefore we do tend to see a strong correlation between the two. Now, we've seen in recent days oil has actually gone on another run higher. Not dramatically so, but we have seen it go on another run higher. The reason for this is because the waivers on Iranian crude exports, which were offered to half a dozen countries earlier on this year by the US, are due to expire early May. Now, just for a bit of extra context on this, so when shortly after the US withdrew from the agreement with Iran that was agreed with the European Union and others, it imposed fresh sanctions on the country. Now, this is a country that was producing, I think it was around 2.5 million barrels a day at the time, and that has since come down to around 1 million barrels per day. And when the new sanctions were imposed, the US offered waivers. Now, it's worth noting, it's not just oil, the oil industry that's being targeted by the US as part of these sanctions, but oil is a major source of revenue for the Iranian government, and therefore for the sanctions to really hurt, the view of the US, of the Trump administration, is that they need to reduce exports to zero. So at 1 million barrels a day right now, that's clearly too high. They did allow waivers for various countries, including India, China, Turkey, and others, to continue to import Iranian crude in the near term while they looked for a new source of oil. And it was expected that at least some of these waivers would be extended beyond the start of May, but it was reported earlier this week, and it was confirmed, I believe, by Mike Pompeo yesterday, that these waivers would not be extended, and that any country dealing with importing Iranian crude after the deadline would suffer sanctions as well. Now, how these are going to be implemented, what the technicalities of it are, we'll have to wait and see. We know that the European Union, for example, has been working on a system whereby they could get round the sanctions that the US is imposing, round the use of the US dollar, which is effectively how, if I'm not mistaken, the US does involve other countries in these in this as well, and try and find a way around it because it remains committed to the agreement with Iran. Now, this is something we'll see details on over the next couple of weeks. But in the meantime, we did see a response in oil because it effectively means that's up to 1 million barrels a day of oil, which are going to come off the market again. So there's two sides to the equation. There's demand and supply. OPEC and its colleagues and Russia, for example, have very much been addressing the supply side of it. They've cut another 1.2 million barrels a day off supply in order to try and obviously restrict supply, which lifts prices. This was at a time when oil was trading around $40 a barrel. The other side of it is demand, and the global economic slowdown and expectations of a further slowdown have impacted that side of the equation as well. So we've got to a point now where oil's trading around $75 a barrel for Brent crude. And I think there are certain countries who are going to be relatively okay with that. If you take another million barrels a day off there, then that has the potential to provide further upward pressure for oil prices. And this comes at a time when Donald Trump has already made his opinion very much felt on Twitter towards OPEC for its commitment to these output cuts and trying to pressure them to reverse course on this, because he doesn't want higher price. Obviously, higher oil prices are damaging for an economy. Now, it's been suggested that Saudi Arabia and the United Arab Emirates and the US will facilitate the shortfall left by Iran. We'll have to wait and see how that happens, how that works, because at a time when Saudis and the UAE are part of the supply cut agreement to then increase production to offset Iran, seems a bit contradictory to me. So we'll see how that goes. But the important thing is oil prices are still rising. So we've actually seen, for example, here, the downward pressure on this particular pair has remained, despite the fact that the US dollar has probably performed better than others and is actually trading. The US dollar index is trading still not too far from its peak. But I think higher oil prices are continuing to support the Canadian dollar. Now, we've got two situations. We've got three situations forming here, as in many of the other pairs. We've got the situation that I would like to see. We've got the situation which potentially is more plausible. And then we've got the situation which, unfortunately, is it seems to be panning out. The situation that appears to be panning out is more consolidation. No surprise. That's what we're seeing everywhere. We've kind of got 133 here to the downside there or thereabouts. We've got slightly lower highs coming from the upside around the kind of mid 134s, but that is not a massive trading range, and we're not really seeing signs of a breakout at this moment in time. We've got a slightly more plausible outcome, which is potential upside here, because the US dollar continues to perform well, and you may wonder why I'm saying the Canadian dollar could underperform given what I've just said about oil. Well, the announcement provided some upside in oil near term, but oil is already trading at relatively high levels. The momentum indicators on those charts are not particularly supportive going beyond, and I think that in the near term there is potential for oil prices to kind of, at least in the near term, potentially peak and even correct a little bit. Now, there's no guarantee here, of course, as with everything, but if that does unfold, then that would alleviate some of the upward pressure on the Canadian dollar. It also depends on what the Bank of Canada has to say today. That will have an important part to play as well. And when you consider this and the US dollar remains strong, then if we do see a breakout of that range, I think the upside potentially is still looking favorable at this moment in time. And then you've got the final scenario, which is the scenario I'd like to see. I'd love to see a break below these kind of 132.50s, below 132. We've been in this long-term uptrend. It's been a slow grind at times. It's certainly that at this moment in time. The 200-233 day simple moving average band hasn't been perfect, but we have kind of rotated just below those levels. I think if we could see a break below there, then that could potentially open up the ability to have some more activity. As I've said with the other pairs, there's the path of least resistance, but then there's the favorable path, and then this would be the favorable path as far as I'm concerned if we want to see volatility spring back to life, which I, for one, would love to. Sterling CAD has many shock horror. It has many of the same characteristics as the cable chart, the pound versus the US dollar. Rather than the floor be around 130, in this case it's around 173.50, 174. It's where we've run into a bottom really since early March, and we've continued to do so. We've got the peak here around the kind of 178s, but we have seen a series of lower highs. Again, I think that's probably some profit taking, but we are seeing some consolidation around these lows now. I would like to see a break below there just to open things up and spark a little bit of interest once again. In terms of next area of support potentially here, I think it's less obvious just because we've had this very choppy, grindy, slow grind higher, very, very choppy markets. But if we're looking around these kind of hit levels around the kind of 172s, this kind of area. You can see that historically this has been a notable area of support here, resistance, and support here, resistance along the way here. So anywhere around there could potentially offer some support if we do see a break lower. But unfortunately, I don't expect the characteristics of this to change too much, just because I think this will be driven by profit taking more so than anything else. And again, this has just been a very choppy grind higher, and that would very much be consistent with that. Kiwi dollar is one area where we have actually seen some movement, thankfully. We've seen a break below these kind of 67s, just above 67s, which is where we'd found support previously on a number of occasions. We did see a break below there, initial spike below with a bit of a corrective move. We saw it tested from below, which acts as some form of confirmation from the downside. If you see a break below a support level and then it retraces from below and it rotates off of that previous support level, that's seen as confirmation of the initial breakout. And since then, we've just been heading south. Now, in terms of potential support here, again, around these kind of 66s looks perfectly reasonable to me, simply because, yes, we had this little spike in between here, but if you look back at this level here when we were coming from below, it was around these 66s where we ran into some support as well here, same from above on this point here, and that roughly coincides as well with the low which we hit during that spike. So around these kind of 66s looks to me a perfectly reasonable potential support level. Again, we'll look and see how that does pan out. Longer term, though, this does look still quite bearish, because longer term, we failed to really hold above that 50 fib here. And now that we've seen that break lower, it's not looking great, if I'm perfectly honest. Again, it's not the most active pair, but compared to what we've seen in many others right now, I think we have to very much welcome it for what it is. And at least we are seeing some movement out of the trading range. We're not seeing consolidation. So like I say, 66 looks an area of interest to me, but the near-term trend is very much down. If we look at the momentum indicators, you've got the MACD moving averages pointing lower. The histogram isn't giving us too much at the minute, and the stochastic is pointing lower as well. So that suggests that momentum remains with the bears at this moment in time. Dollar yen, we have consolidation around the 112. I mean, this is horrible. This is now what, 11 days of consolidation in an extremely tight range. I mean, we're looking at peaks here around what, 112, 16, 17, a low of 111, 65, and for that long period, I mean, that's really grim. But it is also technically probably a little bit bullish at the same time. Just about, we look at the 4-hour chart, and you could even argue, to be honest, it's gone on too long to be a bullish signal. And to be honest, I think that'd be a very perfectly valid argument. But what this is effectively a falling channel here. And in that case, we've got the rally into it here. We've got consolidation. I think it's gone on a bit long, to be honest. I wouldn't be surprised if this did pull lower. But if we can break through 112 and hold above here, then potentially it is just a delayed bullish breakout. I need to see that move somewhere. I mean, that just looks grim for me on the daily chart. If we can see it push higher, then I think it becomes really interesting again around these kind of 112.60s, because you're breaking above a longer term trend. Obviously, that's just, I'd probably still call that a speculative trend line, even though there is a few touches. The real area of interest here comes around these kind of 114s, again, previous highs. If we do have the legs to get there, we may have to wait a little bit of time, because as you can see, that is ultra consolidate. That is a serious case of consolidation. Sterling yen, again, it kind of reminds me a bit of the cable charts in many ways. You've got a few more lines in there because we've added the Ichimoku, but we've hit a peak. We've got a floor around these kind of 144, 145s, and we've got lower highs coming into it. The only thing that this is really lacking is the fact that we're not really in a risk-averse market right now, so the yen isn't really being well favoured. The Bank of Japan could hold something on Thursday, but I think they're probably going to favour a dovish slant rather, but more so than a hawkish one. And with that in mind, that is not necessarily going to provide too much downside pressure on this. If we could say, I think with something like this, what we need to see is a break to one of two things realistically. One has to be a breakout in other sterling pairs, so cable, euro sterling, sterling CAD, etc., which puts downside pressure on the pound, which is what drags this through 144. Or the other thing is we need to do is see strong risk averse markets, which brings yen back into favor and therefore acts as downside pressure on this. I think the former is probably more likely right now, and therefore this is probably worth keeping an eye on. I'd like to see this breakthrough here though, because as with other pairs, a breakthrough would take us through the cloud, through support, through moving averages, and would be consistent with this series of lower highs. So it seems that that could be the way we're heading. But as ever with these things, it's not just a case of anticipating where something is heading, it's anticipating when. Euro yen. I'm struggling to find something interesting to say about this, to be quite honest. Again, we've got this kind of peak around just around these kind of 127s, give or take, to the upside and downside. I'd love to see a break above those previous peaks through the moving average, through the kind of 127s, above 128 would be absolutely lovely. Then we could start to open up more upside here, potentially looking at these kind of 129.50s areas and potentially giving this a bit of a kick. At the moment, we're not really seeing it, and if anything, we look like we could just potentially continue to chop around the Ichimoku cloud. If we do give way to the downside here, then again, you just look like you're destined to continue with this consolidation, and not even an interesting consolidation where we're bouncing between. This is a very slow grind, very slow moves, and very unclear. We've got wide support, wide resistance to the upside. So again, not the most interesting. I'd like to see a rotation high towards these high 127s if we can. And that could potentially drive some interest in the pair. But again, I feel like with all of these yen pairs, the move is going to be driven by elsewhere, and these are going to follow rather than lead. But again, let's wait and see. So that's all we've got time for today. I'll wrap things up there. We have run a little bit over, but not too much, so that's not too bad. Thank you as ever all for joining us. I really do hope you found that useful. As ever, please do check out all our other content on MarketPulse, and this is again where you'll find the recording of this webinar later on. I'll also tweet it out, LinkedIn, etc. Please do check out the podcast and everything that we put out. And if you've got any suggestions, please don't hesitate to do that either. We're looking to create new content on a regular basis, and we've already had some good suggestions through things like utilizing potentially Instagram and things like this, which we are looking into. But any other suggestions, any other way you would like any other ways that you would like to see this content produced and pushed out, let us know, and we will do our very best to accommodate. Is it by your name or LinkedIn? It's under my name, Nita. So if you just search for Craig Erlam on LinkedIn, you will find it on there. But yeah, apart from that, I just wish you all the very best of luck with your trading. I hope you found this useful. I'll hopefully see you again this time next week. And until then, I wish you all the very, very best of luck. Thank you very much.